Recording in progress. Whitney, are you recording?
Looks like it's good.
Hey, there you go, folks. This is the first time we've ever done this on my Zoom app here on my iPad. So let me introduce myself. My name's Armand with Team Armand at DXP Realty. I'm here with my good friend Whitney Bulberg at Carolina Ventures Mortgage. Whitney and I go back a long ways. She's not only our favorite mortgage broker, she's also a good friend of mine. So Whitney, how are you doing today?
I'm doing great. I'm enjoying this October weather.
It's
Like
beautiful, isn't it? Crisp
one of my favorite times of year around here.
autumn weather. Whitney, how long have you and I know each other? I mean, it's getting on many years.
I think it might be close to 20 because we met
Yeah,
when I jumped into the business in '05. So yeah, it's been a long time.
exactly. And folks, Whitney and I have done tons and tons and tons of deals together for our buyers, and that's why I wanted her on this video to quickly explain three options that we may have for you as buyers and also for sellers in terms of getting your house sold. So we're going to talk about three things here today. We're going to talk about the 2-1 buy down program. We're going to talk about sellers purchasing points for their buyers. And we're going to also talk about ARMs. So tell you what, maybe let's talk about ARMs first, Whitney, because I think we may need to put that question to bed. Is that correct, Whitney?
Yes. So historically, many times when interest rates are high, the adjustable rate or ARMs are an option. And the reason being is they offer a lower introductory rate for a certain period of time. For example, a 5-year ARM would be fixed for 5 years and then it can adjust. Same with a 7-year, fixed for 7, and then it can adjust. And many times in an interest rate market where rates are high like they are, they're a great option. But interestingly, right now, ARMs are pricing higher than fixed rate products. So short-term money is more expensive than long-term money. So currently, ARMs are not a good option. So we're kind of looking towards some different options for buyers in order to help, save some money on those monthly payments.
So there you go. ARMs are not really happening right now, folks, if you've been wondering. So we have two other possibilities for you. Whitney, tell us about the 2-1 buy down. How does that work?
Sure. So a 2-1 buy down is essentially a graduated payment. Now, what that means is it's a fixed rate. So it's not an adjustable rate. It's going to be fixed for the life of the loan. But what happens is it has a lower introductory payment for the first couple years. So for example, on a 2-1 buy down, let's say if today's 30-year fix is at 7%, a 2-1 buy down would start at 5%. For the first 12 months, your rate would be 5%. Then for the second 12 months, your rate would be 6%. And then from the third year onward, depending on how long you keep the loan or what's going on with the economy, your rate would be 7%. So essentially, the way a buy down works is it's a graduated payment. You're starting out with a lower payment, it's moving upwards. So it's a good negotiation tool. We're seeing it utilized a lot with new construction. Sellers might offer a 2-1 buy down, and it's really just buying time. We're buying time for the interest rates to improve. And our thought process is that in the next couple of years, they would. So for the first few years, you've got a lower payment, and it's a good product for the right buyer.
So essentially, if we're believing or hoping, oh, but maybe believing is a better choice, that interest rates are going to come down next year, the 2-1 buy down one might be a great option for a buyer, might be a great thing for a seller to offer in order to get their home sold, but it's certainly a great option for the buyer, correct?
Yes, yeah, and it can, incentivize moving forward on a property, particularly like maybe you have a buyer who is coming right out of medical school. Their initial position is going to be a salary of X, but they know that their income will be going up. So something like a buy down may make sense for them. So they'll have more income in the future. And there's also, other buy downs. There's a 1-year buy down, and each one has different costs. So we could, certainly explore what option makes the most sense for that buyer.
And there's a 3-year buy down too, correct?
Yes. Yeah. There's a 3-year buy down too. I'd probably say the most utilized is the 2-1.
Okay, so 2-1 buy down. Keep that in mind, folks. Then there's the option of having the seller pay for points for the buyer in order to buy down their rate for the entire length of their loan. Is that correct, Whitney?
That is correct. So the distinction there is the buy down is a temporary reduction in your interest rate. When you're paying points, it's a permanent reduction for the interest rate for the life of the loan. Okay. But the difference is that's a lot more costly to move the interest rate down so significantly. So, for example, a 2-1 buy down on a $650,000 loan will cost $14,000 today. But something like buying down the rate to 5.25% would cost you $60,000. So you have to spend an exorbitant amount to move that rate down. And that's just, you're never going to recoup that.
Yeah, it just costs time. I mean, we're talking about a difference between a 2-year adjustment versus a 30-year adjustment. It's going to cost more.
Exactly.
That said, we say in real estate, everything's negotiable.
That's
You're
very true.
trying to buy a house and that house hasn't sold in today's market, you might well ask the seller, hey, buy down my points and I'll buy your house. Even if it's $60,000 versus $15,000 or $20,000. Depends on how much of a concession a seller is willing to give, right?
That's exactly right. Because the way that this is formatted on the contract is as a seller concession. So
one way
when
or the other, just a seller concession.
Yes,
right?
just the seller concession. So we could look at it and say, give a few options. Hey, here's a 1.0 buy down. Here's moving the rate down 0.5%. We have some options there on how we want to apply that seller concession.
So it does not even need to be negotiated before you go under contract. The important point thing is just to get a concession of some sort from the seller on the contract, correct?
Exactly. Yes. And we can always explore what makes the most sense at that time.
These are great options. So the 2-1 buy down, seller concession on points. The ARM's probably not an option at this time. Whitney, if folks wanted to get more information about any of these options, how could they get in touch with you?
Sure. The best way to reach me is my cell phone, 919-260-6020. And you can call, you can text, you can also visit my website. And I have a ton of videos on my website as well. It's wikiwhitney.com. wikiwhitney.com.
Very good, very good. And folks, you know how to get in touch with me, teamontheline.com. If you got any questions about anything having to do with real estate, please contact me. Love to talk to you about it. Whitney, thank you very much for this session. Really appreciate it. Great information. I really appreciate everything you do.
You're welcome. Thanks so much for asking me.
Okay, we'll see you later.
Bye.